Street. It's 8 a.m. Eastern. Today is Monday, June 28th, 2010. Welcome back, one and all. Great you could join us. Very special thanks to FX Street. We have, as always, a very fun topic to talk about today. What we're going to talk about today is getting ready for earnings season coming very, very shortly, right around the corner. Now, when we talk about earnings season, we're talking about those quarterly earnings that are released, obviously 4 times a year. January, April, July, and October, they tend to be the most active times of the year in terms of the stock market, but that activity certainly does translate over to the foreign exchange market as well. We know there are, very strong correlations that do exist from time to time between the stock market, like the Dow Jones Industrial Average, and certain currencies. The dollar is one, Japanese yen is another, and the market, meaning the foreign exchange market as well as the stock market, tends to be more active and more volatile during these periods of time. So I think it's important for us to take just a little bit of time today to prepare ourselves for the month of July, the earnings season in July. Now, in my own experience, July, my former years as a stock trader, as a day trader, July tends to be really one of the most active periods of time in the year. It's one of the most tricky times of the year, but it certainly can be the most profitable times of the year. A lot of day traders that I've spoken to over the years have said that the majority of the money that they make in the year is made in July. July is a very special earnings season because it's sandwiched in between 2 very quiet months, meaning June and August. Especially August and even coming into the beginning of September, stock market tends to be very quiet. We know the Congress in the U.S. is on vacation, and we really have a lack of economic news that is released in over the course of August. It's important to talk about this change of events that occurs from June to July, from July to October, because it has a direct impact on how we look at the market and how we trade the market. In quiet markets, let's take an example. We look at, for example, here the euro-dollar daily chart. Let's identify a quiet market, just drawing these vertical lines, and show us this is what a quiet market looks like. This is a market, or a range-bound market, another way to say it, that fails to make new highs or new lows. In this type of market, we would use a range-bound type of strategy, meaning we would use a buy low, sell high type of approach, anticipating that the market will not break out to new highs or new lows. However, very quickly, we can see what happens is eventually this range-bound market turns to a trending market. If we will try to buy new lows or sell short new highs, or buy near the low and sell near the high, we're going to find ourselves in a lot of trouble, because if we buy at the low, the market then breaks down to a new low. It can certainly go a lot lower. It can lead to a lot of losses. Now, eventually, that trending market will turn back into a range-bound market, which the euro-dollar has done again. And in a trending market, by the way, we don't want to use a buy low, sell high approach. What we want to do is use more of a trending market approach. Very simply, we can still look to buy low, sell high, but you only want to do so in the same direction as the overall trend. The trend is your friend in a trending market. In a range-bound market, there is no trend that exists. So we can buy low, sell high. We can fade the trend. We can, go against the immediate grain. But this change of events, this change in market climate from June to July, these are not obviously June, July, but from a quiet market to a trending market, and from a trending market to a range-bound market, again, range-bound and quiet being synonymous. We have to be very, very aware of the overall picture so we can put ourselves on the right side of the trade. July is, again, a really special time of the year because we go from a very quiet June to a very, very active July, and then to an extremely quiet August. And if we can manage to put ourselves, to be aware of this change and put ourselves on the right side of the trade, we can certainly do very, very well. However, I'm speaking actually from a lot of personal experience that, the money that I've made oftentimes in July, I've given back a lot of that, sometimes even more in August. Because in July, you expect the stock market, if it's going up, to continue going up, 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 or down, 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 down. But what happens is we start to buy new highs as we go into August, and the next thing you know, the market just fails to follow through. And the change occurs rather quickly. The change usually occurs within 1 or 2 weeks, that the market will go from range bound to trending and then trending to range bound. Really quickly, take a look at this website. This is a website that I've used for years. Type in the web address. It's www.earningswhisper.com. And on the left-hand side of that page, there's an earnings calendar button. This was the first real big company that I found on the calendar. Now, earnings season does not start July 1st. Actually, Alcoa, which is a Dow component, is scheduled to report earnings July 12th. Focus on the Dow components because those tend to really move the market more than others. And the Dow components, I'll pull up the Dow components right here just to give you an idea of which companies that we're looking for. Dow components. Google's really a great thing here. Dow components, and we can actually even type in symbols. All right, there we go. And what we're looking at, this is just from Yahoo Finance. These are the Dow components that we want to watch. I know that, most of us probably focus our attention towards the foreign exchange market, but what moves the stock market moves the foreign exchange market. Sometimes it's non-farm payrolls. That's the number at the end of this week. Sometimes it's the Fed meeting last week or CPI numbers. But during earnings season, focusing on these big companies because those are the companies that tend to move the market to a really great degree. These are the current Dow components. Alcoa, American Express, Boeing, Bank of America, Caterpillar, Cisco, Chevron, DuPont, Disney, GE, Home Depot, Hewlett-Packard, IBM, Intel, Johnson & Johnson, JP Morgan, Kraft Foods, Coca-Cola, McDonald's, 3M, Merck, Microsoft, Pfizer, Procter & Gamble, AT&T, Travelers, United Technologies, Verizon, Walmart, and ExxonMobil. Those are the 30 largest companies that represent the Dow Jones Industrial Average and certainly can move the market. When you look at earningswhisper.com, look for those companies. Again, just go to Yahoo Finance. They have a great list of those Dow components. However, going back to foreign exchange, if we know historically over time that earnings season, I believe Alcoa on July 12th is the first Dow component scheduled to report their earnings. Generally speaking, from what I recall, July earnings season tends to start around the second week of July. The latter part of the second week of July, July 12th, is Alcoa. That's the first one I saw. Now, if we anticipate momentum to start to pick up at that point, we can also surmise that momentum will pick up in the foreign exchange market around the same period of time. That would have the most direct effect to dollar crosses, such as the euro dollar, pound dollar. It also certainly could affect the yen crosses, euro yen, pound yen, etc. So really, the whole foreign exchange market begins to develop a lot more momentum. Now, the indicator at the bottom, we should see at the bottom of this chart, which is the euro dollar daily chart, is the RSI Relative Strength Index. What we do oftentimes throughout our FX Street webinars is we analyze the different currency pairs and we make note of the position of the RSI to try to find what is the strongest versus weakest currency pair. Now we know the RSI indicator, the RSI Relative Strength Index, measures the relative strength of the currency pair in question on a scale of 0 to 100. Indications above 70 are considered to be very strong. Indications below 30 are considered to be very weak. Now we know all the time there's at least 1 or 2 currencies that are moving. But I really want to focus in for a moment and take a snapshot. What does the market look like now? We're coming into the end of June, beginning of July. It's considered to be a very quiet time of the year. Take a look to see what the foreign exchange market looks like now in terms of relative strength. Do we have fast-moving markets right now? Forget about the price charts for a moment. Just focus in on the RSI indicator at the bottom. Well, the euro dollar RSI, just going to read these off, 51 on the euro dollar RSI daily chart. Now, again, what we're looking for is an indication above 70 or below 30, which really shows a fast market. And I think what we're going to prove is that right now we do not see a lot of fast markets. Pound dollar is pretty strong lately, only 64 in the RSI though, not officially a fast market. Dollar yen has been considerably weak lately, but yet the RSI on the dollar yen daily chart's 33. Dollar Swissy is the only currency pair that actually shows us a somewhat fast market. RSI right now indicates a level of around 26. That's the only daily chart on a dollar cross so far that we've found that shows a fast market. Dollar CAD almost right in the middle of the trend. Dollar CAD RSI daily chart 49. Aussie dollar daily chart RSI tells us 57. Kiwi dollar 63. We could certainly go through the yen crosses and the other exotics as well, but I think you're going to find pretty much the same consistency throughout. The majority of the currency pairs that we look at, I mean, after all, we took a look at 1, 2, 3, 4, 5, 6, 7 currency pairs. Only the dollar Swissy officially has at least what I would consider to be a fast market. Lately, we've seen a very, very strong Swissy and a very weak dollar. Now, just to step back for a moment, what makes this RSI move? What creates a fast market? Well, ideally, what we want to try to find is the fastest moving currency pair. What makes a currency pair move? When one currency within the pair is very, very strong. In the dollar Swissy, in this case, the dollar is very, very weak. Swissy is very, very strong. When we have one currency moving really far up and another currency moving really far down, or moving very quickly to the upside down sign, that makes the currency pair move. That makes the chart move. Now, fundamentally, to take a step back for a moment, why has this occurred? If you recall, I believe we spoke about this during one of our previous webinars when we focused in on the central bank meetings. Swiss National Bank did not raise rates. However, and the rates, I believe, still are maintained at 0.25%. However, Swiss National Bank, which had been fighting a fear of deflation for quite a while, came out during the last central bank statement. Swiss National Bank basically said, we don't see a risk of deflation. In fact, things are getting a little more inflationary. And that maybe there's a chance that, not now, but sometime in the future, we're going to start raising rates. That statement, from my own observation, began a very, very strong rally in the Swiss franc. Also, with gold very, very close to historic highs, we know what benefits gold. When gold goes up, it tends to benefit the Swiss franc. There's a pretty strong correlation that exists between gold and the Swiss franc. There's a lot of gold reserves that are held in Switzerland. And for that reason, for many, many years, there's been a strong correlation. So you take a look at the very strong gold market. You've taken into consideration Swiss National Bank that has been raising rates. I'm not raising rates, but that has indicated that they may raise rates. At least the deflationary pressures have subsided and inflationary pressures are starting to return. Again, when the central bank sees there's a risk of inflation, the expectation is they'll raise rates. Take a look at gold, take a look at inflationary versus deflationary pressures, and we see that the Swiss franc has been very, very strong. Now, put that against a rather weak dollar, and we know the dollar's been weak for quite a while for a lot of different fundamental reasons. Unemployment at 9.7%, really a lack of any kind of inflation. When we talk about inflation, not to digress too much, but there really is a very strong connection between inflation and the currency strength. In fact, if you were to ask me, what is one economic barometer? I like to focus in on a lot of economic numbers, but if I had to focus on one economic number versus another, I would suggest to focus towards those inflation reading numbers. Consumer price index, producer price index. Non-farm payrolls are released, but we know they're always revised after the fact. The unemployment rate's at 9.7% in the U.S., or I think 10.1 in the Eurozone, but it's a little bit more of a subjective number. The Federal Reserve comes out, does not change rates. However, they change the language in a statement, not so easy to interpret all the time. However, if we measure the cost of money, meaning inflation, on the consumer level, consumer price index, or the producer level, producer price index, there's a very strong correlation that when we as consumers and we as producers start to have to pay more for the same goods and services, when airline tickets become more expensive and all that other good stuff becomes expensive, our money loses value. We lose buying power. Federal Reserve, or any central bank for that matter, says, well, now we have to start raising rates to protect the value of our currency. Otherwise, an airline ticket will go from $500 to $1,000. A loaf of bread will go from $2 to $5, etc. So there's a very, very distinct relationship between inflation and these central banks. The reason I bring this up is because we see two very, very different events taking place. Swiss National Bank, which saw a really, a great pressure, a high pressure of deflation, they said that has subsided and that inflation might be right around the corner. Well, take a look at the strength in the Swiss franc. Put that against the dollar in the U.S. If we look at the CPI and PPI numbers, they've been exceptionally weak lately. We've seen declines lately in inflationary pressures, meaning things are not getting more expensive. We know the housing market's not necessarily getting more expensive. And if we take away the more volatile components of inflation, meaning food and fuel, we talk about the core CPI and the core PPI numbers, inflation really is not picking up anytime soon, or has not picked up in the recent past. So you put really no inflation in the U.S. versus the risk of inflation in Switzerland. That's why the dollar Swissy has been so trendy lately. Now, just for a moment, just because we're talking about the dollar Swissy, we are at a critical level. I do want to bring it up. We're at 108.46 right now. Dollar Swissy has really been moving to the downside. We hit lows today of 108.31. Take a look at the former highs. The last former highs of 108.97 on February 19th. Former resistance very well could become new support. And in addition, if you draw that uptrending support line going back to November, December of 2009, that former support level today is the first candlestick to go below that support level. We had a candlestick wick on April 1st, but taking aside, ignoring that because it was just a long candlestick wick, which I think maybe could be the case today, although we'd really have to see a strong dollar rally before the end of trading day today. Before the end of business today. If we close below the support line, that'll be the first time we've broken below the support line since the line started November 27th of 2009. That's pretty big. That's a 7-month trend line. Today is the first day. I'll zoom in just to give you a little bit of a better picture of what this looks like. This is a big event. This is a big deal, the Swiss franc breaking below here. Now, this very well could become former resistance, new support. However, if we close below this trend line, I certainly would not want to try to buy the dollar Swissy. I think eventually the dollar Swissy is going to be a fantastic buy, but you want to wait for that confirmation. Dollar Swissy, again, why we're talking about it, it's the only currency pair from our dollar crosses, euro dollar, pound dollar, etc., where the RSI, the relative strength index, is below 30 or above 70, indicating fast market. Now, why do I bring this up? Take a look in the past. And again, every earnings season, we're going to see a different currency pair react differently. In this particular case right now, the dollar Swissy is the fastest moving currency pair because we have a weak dollar against a strong Swissy. Maybe in another month, it might be the Aussie versus the CAD or the Kiwi versus the pound. Situation is always different in FX. However, take a look at what the market looked like going back to last June. Last June, RSI right in the middle of the range, indicating a level just about 50, 51. Take a look at what happened. We come into July, but again, remember, earnings season, I believe, officially starts, if you take a look at those Dow components, second week of July. So we take a look at from second week of July through, I would say, the first week in August, 3 or 4 weeks. Take a look and see what happened. Dollar Swissy ended up collapsing. Going into actually early September. Take a look at the euro dollar RSI in June. Euro dollar was very, very quiet. We know euro dollar and dollar Swissy have a pretty close and inverse correlation. Dollar Swissy euro dollar didn't hit 70, but certainly didn't move to the upside coming into July. Euro dollar and dollar Swissy did not represent those ideal currency pairs to trade last July earnings season a year ago. However, take a look at the dollar yen. June of 2009, dollar yen RSI was around 45. Dollar yen RSI July 10th hit a level of 30, and I think maybe even a little bit below that. Dollar yen started to really move coming into the first couple of weeks in July of last year. Last year, we take a look at the RSI. This is June 12th. was around 47. Well, very, very quickly, July, end of June moved up and then turned around, broke below 30 July 21st. Aussie dollar, going back to June, depending on where you look at June, we're looking at a reading right in the middle. However, RSI hit 69 August 4th. Beginning of August is still officially earnings season. And of course, the Kiwi dollar, just to complete the circle, 45 RSI on July 2nd. However, as we go into the brunt of earnings season, August 4th and 5th, RSI went up to a level of almost 70, around 69. So we can certainly expect momentum to increase in the stock market. We can expect the momentum to increase in the foreign exchange market. The real trick is trying to identify which currencies are most likely to move. Now, we don't have to be psyching and have a perfect guess, but make an educated guess which currencies are most likely to move and which currencies are most likely to move in what direction, up or down. There's a question. Is this fast drop in the dollar Swissy saying dollar will drop more significantly or fundamentally shift to dollar bearish? Well, I would argue, it's a great question, Jack. I would argue the sentiment has already occurred. Dollar Swissy, I would not, I don't like to look at a chart like the dollar Swissy, I'll zoom in and say, well, we're now turning bearish. Dollar Swissy already turned bearish. When was it turn? Well, when you trade with the RSI indicator, what you want to do is you want to buy when RSI crosses below and back above 30 and sell short when we cross above and back below 70. That last crossover actually occurred the end of May of this year. May 27th, the RSI crosses back below, we were above 70, crosses down to 66. That was when, and I'll draw a line over here just to show you exactly when that occurred. That is when the momentum really turned to the downside. I think the dollar Swissy, there you go, erases the line over here. I think the dollar Swissy momentum turned to the downside a long time ago. I think that the current trend is certainly to the downside. Difficult to say how far we'll go down. I think sooner rather than later, though, the dollar Swissy will represent a really good buy. The question is when. Now, we want to see the dollar Swissy. What are some signals to look for? We want to see the dollar Swissy obviously stop going down. We want to see it stop going down on some sort of logical, technical level. Erase all our lines and really take a close look at the dollar Swissy. In fact, I'm going to delete over here the indicator just for a moment. Now, basic FX technical analysis 101. If we're an upturning market, I draw upturning support level, connecting those very, very significant lows. In a downturning market, I start with consistent. So take the first lows, November 26th of 09, connect them on up to the next most significant low of April 1st, 2010. Now, I could have very easily drawn the support line to connect the lows to January 14th, but that would mean that the April lows would have intersected this line. So I like to use the most recent significant lows. What's very interesting, we see over here, is that 108 is where this line currently indicates we could have possible support. That's big. Now, in addition to that, I like to draw horizontal lines at the most significant highs or lows. The last most significant high, just right around 109, occurred February 19th of 2010 of this year. We crossed below that, so we draw more horizontal lines near the next significant lows and significant highs to try to extrapolate where the market might find now support or resistance. Now, in addition to that, let's draw our very, very big Fibonacci levels from those lows in November 09 all the way up to the highs of June of this year. Take a look at the 50% Fibonacci retracement level. That emerges actually right where we are now, uptrending support around 108. So I would say, with no other technical analysis done, or fundamental analysis for that matter, I would say we have a very big suspect level that's emerging between 108 to 108.30. We're at 108.30 right now. So I think we're coming very close to what could be a big, big turning point in the dollar Swissy. It's true we did cross below the former highs of 109 going back to February, but then again, those are long candlestick wicks. If we look to 108, 108 does a better job of really identifying that triple top pattern. Not an exact sign. Fundamentally, I would not expect to see an improvement in the U.S. dollar until we see better economic data. But then again, the market's always a forward-looking mechanism. I think the market will start to turn before the good news comes out. Just like the market started to go to the downside before the bad news really came out. So fundamentally, it's not always the case where Swiss National Bank comes out, makes a statement, wow, look at, we have inflation right around the corner, let's start buying Swiss francs. That does happen from time to time, but unless it's a real shock to the market, the Swiss National Bank statement was a shock to the market. So I think that was something that really woke up the Swiss franc. More than likely, though, I think you're going to see the market move in expectation of that change of events. Technically speaking, though, we have a very big support line intersecting with a 50% Fibonacci retracement level. We only have a few Fibonacci levels that could represent possible support. In other words, if we break below 108 and the 50% Fibonacci level, the 61.8%, the next Fibonacci suspected support, that's at 106. But we know, looking at the RSI again, RSI, Relative Strength Index, we've already crossed below 30. The true buy signal doesn't occur until we cross back above 30, but because we're already below 30, shows us, I think, that we're closer to the end of this move than the beginning. That's for sure. The immediate trend is to the downside. Long-term traders, don't try to get involved in dollar Swissy until you see further signs of a bottom, meaning double bottom patterns. RSI crosses back above 30. Maybe a big economic event. Maybe this Friday's non-farm payrolls will be that big economic event. Who knows? Also, we see gold. Let's take a quick gold, by the way, because it certainly has a pretty large influence. Take a look at gold. 1254.40, hitting highs at 1265.10 on a futures basis, going back to June 21st. And these are historic highs, by the way. Gold has never seen higher highs on a price-to-price basis. I don't necessarily believe that gold's going to stop anytime soon. I mean, anybody betting against gold so far would be wrong. So I certainly don't want to be, wrong on that trade. But gold is not the only factor in the Swissy strength or weakness. Question is, can this be a retracement of the current move in dollar Swissy? Yeah, absolutely. I think unless we break below this trend line, to make it easier, unless we have a solid break below 108, I think that this pullback right now is exactly that. Pullback and retracement, same thing. Meaning, until we solidly break below this trend line and the 108 figure, I still believe that the dollar Swissy is a long-term trend to the upside. This long-term trend line, again, we started going back to November of 09. There's no reason to believe this is any different than any time in the past. We're making, on a long-term basis from November of 09, we're making higher highs, higher lows, higher highs, higher lows. And again, higher highs, if we stop here, higher lows. When do we really know for sure? When we make a double bottom pattern at 104.34, lows of April 1st. That would obviously already would have broken this uptrending trend line. But so far, there's no reason to believe that the dollar Swissy will not continue to go down. Continue to go up. So I think it could represent a fantastic long-term buying opportunity, and I think that the July earnings season could certainly be a catalyst. Now, we spoke about, I believe it was in the last webinar, we spoke about correlation. For those of you that joined us from the last webinar, you may recall one of the strongest correlations that tends to emerge over the past couple of years is the relationship or the correlation between the dollar and the yen and the Dow Jones Industrial Average and stock market. Think of the dollar and the yen right now in terms of their own inherent interest rate. Very, very low interest rates. Japanese interest rate, 0.1%. U.S. rates, anywhere from the 0 to 0.25% floating rate in that area. Okay. Now, when the market is scared, when there is fear and pessimism in the marketplace emotionally, we buy low-yielding currencies as a flight to safety. We buy gold. We buy those financial instruments that we perceive to be safer, like bonds, and low-yielding currencies like the dollar and like the yen. When that fear emerges in the market, we sell our high-yielding currencies and we sell what we consider to be a more risky asset, stocks are included. Therefore, when we talk about correlations, let's try to pull up two charts together over here. When we talk about correlations, we should talk about the correlation between the Dow Jones Industrial Average and the dollar-Swissy currency pair. Lately, what we've seen, I mean over the past couple of years, there's the Dow. When the Dow goes up, the dollar and yen go down. When the Dow goes down, the dollar and the yen go up. Now let's put this on an even scale. Zoom out. Now the top chart, please let me know if you don't see this. Should see this all right though. Let's go here. November of 09. Let's zoom that out. I just want to get everything on an even scale. All right. That's not exactly right. Okay. I didn't hear it. We'll try to do our best to keep this on an even scale. The top chart represents YM. That's the futures for the Dow Jones Industrial Average. When did the Dow hit that very, very big high? Roughly that occurred end of April of this year. When did the dollar-Swissy, I hope this correlation works out. End of April, it does work out. Remember, we're not on a completely even scale. Take a look to see what the Dow Jones Industrial Average, I'm going to take the lowest low in dollar-Swissy just to keep us honest. So April 1st, the dollar-Swissy hit those very big lows of 104.34. April 1st of this year. Dow Jones Industrial Average, erase the extra lines. Dow Jones Industrial Average close to its very, very big highs April 26th. When the dollar was at the lows, the Dow was at the highs. Going back to a very, very big lows on the Dow Jones Industrial Average, there's I think rarely that you'll see a perfect relationship over here. Meaning in terms, there's always a lagging effect. Either the Dow comes before the dollar or the dollar before the Dow. However, what was the lowest low of the Dow Jones Industrial Average going back to 6,600 in that area? That occurred beginning of March of 09. Where did the dollar-Swissy, what did the dollar-Swissy look like March of 09? March of 09, let's draw a line. Dollar-Swissy, you know what? The dollar hit a significant high, just to be completely fair, a little bit before that. November, December. There's always a little bit of a lag. When the Dow hit its lows, the dollar hit its highs. And I think you'll see a much more strong relationship when we look at the yen crosses. It also exists with the U.S. dollar, though. Point being, when the Dow Jones Industrial Average, when the stock market goes down, we run out of stocks, we run into bonds. We run out of high-yielding currencies, and we run into low-yielding currencies. That's why the dollar did so well. Now, the dollar-Swissy is not the best currency pair to really demonstrate this relationship because the dollar and the Swissy both have low interest rates. If you really want to accurately look at this, we would look at a currency pair like the Aussie dollar or the Aussie yen. Extreme high yield versus extreme low yield. We can actually do that. Let's take a look at the Aussie dollar because I just want to be completely fair in this comparison. Here is the Aussie dollar. And I think, coming back toward the topic of our webinar, and this is, certainly apropos, that we don't know what direction the market's going to go, but we do in July. But we do know that the market is likely to really get very, very fast in July. So find out which direction the market's most likely to move and honor that direction when we talk about the trading month of July. Remember those significant highs, April 26th of this year, when the Dow Jones Industrial Average hit those significant highs. We take a look at the significant lows, actually a little bit after that, going to the mid-May, Aussie dollar hit its lows. Again, there's not a perfect relationship, but extreme high yield in the Aussie versus extreme low yield in the dollar, and that's what you see. Take a look at those very, very big highs in the Aussie dollar. That was November of 09. And I would, if I was a betting man, I would say we'd see the extreme lows November-ish, in the Dow Jones Industrial Average. Actually, a little bit less July. That's too far back. We're taking a look at November. The Dow Jones Industrial Average did in fact pull back. Coming into July, what I think you'll find is that the majority of the RSI indications will hit the middle level, just as we see over here. Well, that's dollar yen. Pound dollar, not a good example. Here's a good example. Euro dollar. This is what the market looks like now. I think eventually what you'll see is the RSI will really start to move as the market picks a direction. Question is, so what you're saying is the dollar yen correlates with the stock market and yen crosses. For the most part, yes, because when we think about the market, it's the most macroeconomic view. We think about risk versus fear versus greed, risk versus reward, optimism versus pessimism. When we are in a good mood, when the market's in a good mood, when things are going well and we're making money, we want to take additional risk. We have risk appetite, as they say. We buy stocks and risky assets and higher yielding currencies like the Aussie and the Kiwi. When things are scary, when the market goes down, we start to lose money, we tighten our belts, we become more risk adverse. We sell the high yielding assets and the more risky assets, and we buy the low yielding currencies like the dollar, like the yen, like the Swissy, and we buy those financial instruments that are perceived to have more safety, treasury bonds, municipal bonds, etc. Now, you may say, well, European rates, they're pretty low, right? UK rates are pretty low as well. But there's a difference, because when we talk about Europe, we have to consider, the fundamental issues in the ECB right now, or, in the Eurozone right now, that the European Central Bank has to contend with. The debt crisis in Greece, the possible, or the rumors at least, of maybe a debt downgrade in a credit rating downgrade in France. These very, very big issues in Spain as well. When we talk about the UK, well, there's certainly issues, I don't think to the same degree as the EU, but there are issues. But we know the Bank of Japan is not going to cut rates because they can't. Not really. Federal Reserve can't cut rates any more down than zero. So we know that there's a higher level of safety in those currencies without those risks of a downgrade, without those risks that we're going to cut rates even further. But yes, you're absolutely right. The best way to look at that is you look at a currency pair like the Aussie yen. Aussie yen, because Aussie has very high yielding rates and the yen has very low yielding rates. Now, oh wow, time is going by fast. So we know coming into July, let's first try to identify what we know. We know volatility right now is rather slow. We know historically speaking, volatility will certainly tend to pick up in the month of July. Which direction? Which currencies? Well, what motivates July? Earnings season. Those 30 components that we read in the beginning. Alcoa and Caterpillar and DuPont and IBM, etc. We want to see if those companies come in with better or worse than expected earnings. Doesn't as much, I don't think it's as necessary to examine is Alcoa making as much money as they could, is IBM selling as many computers as they should. However, what do the analysts expect? Now, on one side of the coin, it could be a pretty positive month for the Dow Jones Industrial Average because the expectation, I think, is so low. Things are so bleak, really in so many different nations right now. When we expect the worst, anything other than the worst could be a positive surprise to us. I hate to be a consummate bear. However, I tend to disagree with that personally. I think if you take a look at the dollar Swissy currency pair, I think this kind of forecasts what kind of July we may have. Because the dollar Swissy has gone down, down, down. And we know that old axiom in financial markets, buying the rumor, selling the news. Well, coming into the month of July, which is a very important time of the year, the dollar's been down, down, down. And the stock market, we know, tends to move in the opposite direction of the dollar to a large extent. As the dollar's gone down, that's propped up the Dow Jones Industrial Average. I think coming into July, we oftentimes see a reverse, a turn of events. So with the dollar Swissy very close to a big, suspected support level as well, I think we could be in store for a big reversal to the upside. What would happen to the Dow Jones Industrial Average if the dollar starts going up? Well, if the dollar starts going up, it means that capital around the world is running into safety. We're running into a currency that we think we need to buy out of safety. That could be the dollar. I think the dollar to a larger extent than the Swiss franc. You take a look at what's some other currency pairs? The Aussie dollar. Been quite strong lately, right near the highs, and that shows us that the dollar has been very, very weak, and there's been optimism out there. As lackluster as the Dow Jones Industrial Average has felt lately, considering the position of the Aussie dollar, considering the position of the Kiwi dollar, we're a lot closer to the tops than we are the bottoms. So in other words, I think if July we see a reversal, which oftentimes does happen, I think that you'll see the dollar go up, and I think you'll see the Dow Jones Industrial Average go down. Now, while we have some time, let's try to delve more into the actual currencies and discuss which currencies may move in which direction based on the fundamentals that we know of right now. Question is, affection of 8 and then 2.5% for say the dollar Swiss pair? It's a great question. It's a great point, I should say. I didn't hear that. It's really actually kind of shocking. There's a prediction of the 8 rate hikes. I'm assuming it'll probably be a quarter point hike each hike over the next few meetings for the next 2.5 years. If you subscribe to that, I'm sure a lot of people do. If you subscribe to that, it certainly would, technically, logically, you would expect this to translate to strength in the U.S. dollar, because the anticipation of higher interest rates would certainly tend to lead people to buy, traders to buy the dollar. But I think that the market focuses in on the more immediate possible future. Meaning, 2.5 years from now, it's certainly, I wish I would know where the dollar or U.S. rates would be 2.5 years from now. But the fact of the matter is we have a lot more, we have corporate earnings in July. We have the congressional elections this November. We have the holiday shopping season after that, November, December. We have a lot of really big fundamental events right around the corner. That's not to say that 2.5 years from now is not important. It absolutely is. But the market tends to focus on the next big event. Last week, it was a Fed meeting. As soon as the Fed meeting came out, what do we have after that? We had Canadian retail sales. We had some other big U.S. numbers. And then what's the market focusing on now? Non-farm payrolls at the end of the week. After non-farm payrolls, we know Congress was on vacation, but we have some other Fed meetings or some other central bank meetings right around the corner as well. So, I think it's important. I don't think that you'll see that strength in the dollar Swiss or any dollar cross. I don't think you'll see that occur quite yet because the market is much more focused on what's going to happen in the near-term future. Speaking of earnings season, if we know that momentum, generally speaking, has a tendency to pick up, what we want to do is try to identify which currencies do we think are most likely to move and in what direction. This is taken from our previous webinar when we spoke about central banks. We know that the European Central Bank, they've kept rates unchanged at 1% for quite a long time. European Central Bank probably not going to raise rates anytime soon. We have the debt crisis in Greece. We have the debt crisis in Spain, as well as other nations in Western Europe. We have in the UK a 0.5% rate. And we know most recently what really separates the UK from the EU right now is the last Bank of England meeting that was June 10th. Last week we had the minutes from that meeting, and Andrew Sentence, he was one of the Bank of England members. There was a vote 7-1. Andrew Sentence was the only member to vote for an interest rate increase. to 0.75%. He was outvoted 7-1. But this is a real big turn of events. And last week, if you remember, we saw quite a bit of strength in the British pound because the anticipation is that maybe the Bank of England will raise rates sooner than a lot of us expected. And I think if you continue to see signs of improvement in the UK economy, and Andrew Stenton specifically cited the inflationary pressures, if you continue to see the inflationary pressures in those numbers increase in the UK, I think you'll see improvement in the British pound. A lot more than the EU and the euro currency. Can you give some focus on the euro-dollar relation with the Dow Jones? Let's take a look at those charts while we discuss these different central banks. I'll pull up the charts and try to make them as simple as possible. Now, speaking of which, we just had this G20 meeting. The 20 largest economies in the world met in Toronto over the weekend. Had some riots as well. But aside from that, there was a real difference of opinion between different nations. The U.S., President Barack Obama, focused on stimulus and spending our way out of this recession, whereas, and it was really actually kind of shocking to see that a lot of countries that we would not normally anticipate to do so, such as Spain, such as France, and such as the UK, and also Japan, by the way, focusing more on cutting debt, cutting the deficit, cutting their budget, cut, and that will eventually improve the economy. That difference and that theme, I think, is going to be a very, very big theme as we continue to try to go through our recovery. Doesn't make me extremely bullish on the U.S. economy or the U.S. dollar to a large extent. Makes me a lot more bullish on the British pound more than any other currency, because I think, at least in my opinion, if I may interject, I think that's the right way to go about it. I think that cutting the deficit and cutting the budget is the right way to go, not as opposed to spending away out of the deficit. Taking a look, by the way, at the Dow Jones Special Average, which is the top chart, euro dollar is the bottom chart. Euro dollar hit very, very significant highs. Euro dollar hit very significant highs going back to November, actually December of last year, just about 7 months ago. Delete these other lines, just to be perfectly clear. And we see that the Dow Jones Special Average, it's not an exact correlation because really the euro currency and the EU economy has a lot more EU specific issues. In other words, Greece, Spain, and these the debt problems that have occurred over there. Generally speaking, the correlation that does exist is that when the Dow goes down, the dollar goes up. And therefore, when the Dow goes down, we tend to see the euro-dollar currency pair go down. We see the euro-dollar hit significant lows June of this year, that's this month, and the Dow Jones Special Average not too far off of its lows for the year either. It's one of those relationships that's probably a little bit weaker than most because the euro currency has so many euro-specific issues that take away from this other correlation. But I think generally speaking, I think you'll see a positive or a similar correlation. When the Dow goes up, the euro goes up. When the Dow down, the euro goes down. Now, we've seen a lot of interest rate hikes in Australia. Reserve Bank of Australia has recently paused in raising rates. We've seen one interest rate hike in New Zealand, but they have the perception is Reserve Bank of New Zealand might pause in raising rates. Remember, Aussie, Kiwi currencies are those currencies that we buy when things look very optimistic. But until things look really optimistic, and especially since higher rates in Australia have really started to at least pull the economy off out of fifth gear and slow it down just a hair, I don't think you're going to see tremendous rallies in Aussie or Kiwi until we see not only the Australian economy or New Zealand economy improve, but the worldwide consensus improve. Aussie and Kiwi being so much higher yielding currencies than the others that we watch, they react a lot in terms of those broad-based macroeconomic, emotions, pessimism versus optimism. Bank of Canada raised rates for the first time in June of this year, just in the beginning of June. Bank of Canada said, hey, at the time they said, hey, things look good, things are starting to improve. Well, recently, last week, Bank of Canada retail sales came in lower than expectation. The CPI, I believe, was the other number. That did not come out good. I believe this week we have GDP numbers, gross domestic product numbers in Canada as well. But because those numbers last week were so poor in Canada, there's been a big shift in consensus in perception in the Canadian dollar. Took a lot of wind out of the sails of the Canadian dollar. There's a lot of analysts out there who don't think that the Bank of Canada will raise rates again before the end of the year. If you had told those analysts at the beginning of June, they probably would have been a lot more optimistic. So until those numbers improve in Canada, I don't think you're going to see a lot of strength. We know the Swiss franc. We know there's a little bit of a greater perception of inflation. That's given us recent strength in the Swiss franc. What am I leaving out? The numbers this morning in Japan were not that hot, although Japan is also following, I don't know who's the lead, but certainly following the lead in Europe and in the UK in cutting the budgets and cutting the deficit. So that, I think, certainly could bode well for the Japanese economy. However, I don't necessarily know if that's going to lead to strength in the Japanese currency because the Bank of Japan, well, they keep rates very, very low because low rates are good for an export-driven economy like Japan. That's not like the U.S. or Europe. So the only currency, let me see, I talked about Aussie, Kiwi, CAD, dollar, yen, Swiss. What am I leaving out? I think that's it. Aussie, Kiwi, CAD, dollar, yen, Swiss. The Brit and the euro and the pound, obviously. My real favorite currency, and in terms of fundamentally speaking, so far, is the British pound, because not only, at least in my opinion, I think they're taking the right steps, they're going in the right direction. Let's cut the deficit and let's, really encourage growth, not through spending, but through savings and through a more efficient economy. But also, the UK is not plagued by the problems that their neighbor, meaning the EU, has. Greece and Spain and those other nations. So I think that, in my opinion, I'm quite bullish on the pound. Coming into earnings season, I think that we're not going to see really, really good numbers in the Dow Jones Industrial Average component. I would expect that to weigh heavily on the Dow Jones Industrial Average stock market. If I had to guess, I would guess the stock market to go down in July and not up. Take a look at the Dow, by the way. And because of that, I would expect maybe dollar strength and yen strength based on the Dow going down. By the way, speaking of the Dow Jones Industrial Average, futures right now, 10,088. Take a look at that first high of what I think could be a massive head and shoulders pattern. 10,681 were the highest January 19th. Then we had a higher high. That's the head of the head and shoulders. It's 11,201. That's on April 26th. The second shoulder, the third high, which oftentimes falls very close to the high of the first shoulder, might not have been able to get all the way up there. Now, we did hit highs of 10,531 on June 21st. That fell very short of the highs of almost 10,700. If we do not break those highs, that not only paints a bearish picture, paints a very bearish picture in the Dow Jones Industrial Average. If, on the other hand, we break above Dow 10,700, I think that you'll have a very good chance of seeing the Dow move to higher highs and eventually break those 11,200 highs, and we'll be off to the races. That is the neckline of the head and shoulders, 10,700. And the first sign of that would be if we broke 10,531 highs of June 21st on the futures. The shoulder line, which is the bottom line of the head and shoulders, the lowest lows emerged on a 97.46 on June 8th. In other words, 9,700. I think if you see the Dow break below 9,700, I think we could be in store for much lower lows. There's a 50% Fibonacci retracement level that marks a big deal. That's around 8,800. So I think as we come into July, we have some time. It'll probably not occur at least until the second week in July. But as soon as we see the Dow below 9,700 or above 10,700, I think if we see below 9,700, that'll send the dollar and the yen higher and all those other currencies lower, especially the high yielding currencies lower, like Aussie dollar, Aussie yen, Kiwi dollar, Kiwi yen. I think those will go a lot lower if we break 9,700. If we go above 10,700, that will take capital out of the dollar and the yen, those lower yielding currencies, and put them into higher yielding currencies. And I think would paint a very, very nice picture for improvement in the UK and the British pound. That is my general consensus. But again, just to sum up, consult earningswhisper.com. Please be very aware of which companies are scheduled to report earnings, especially those Dow components that you can find on Google. Those tend to be the most significant market movers. And note the market reaction when those Dow components report their quarterly earnings. That can lead the Dow to new highs, new lows, and in turn have a direct impact to the foreign exchange market. With that said, I am officially out of time. However, if you want to contact me directly, please feel free to do so, www.forex.com. We thank you all very much for joining us. Very special thanks to FX Street. I look forward to seeing you back soon. Back inside the Forex Lounge. Back inside FX Street.